Hello there, it's Stephen Thomas with Reports on Housing, and we have another housing debrief. Thank you so much for joining us. This week we're talking about housing is shifting. You're wondering exactly what is going on. Well, let's get into it. And that is the Fed had made a rate cut of 0.5%, and they did that. They did that a couple weeks ago now. So they announced the rate cut in the federal funds rate. That is a short-term rate, and that is how banks borrow from each other, and it's set by the Federal Reserve. And it was all the way at between 5.25% and 5.5%, and they reduced it by 0.5%, making money to exchange from bank to bank cheaper overnight. Now, what is tied to the federal funds rate? It's credit card debt. So credit card debt, automatically that percentage rate comes down a little bit, as well as automobile loans. Those two come down a little bit. And HELOCs, also known as home equity line of credit. You might know this as an equity line from houses. Those two go down with cuts in the federal funds rate. Now, if you recall, a couple weeks ago when they did the rate cut, people were perplexed. And that's because what we had rates that were at a low of 6.11%. And then from that point on, kept on rising. They have been rising. As a matter of fact, they rose to the highest point today from where it was a day before the rate cuts happened. And you're wondering, wait a minute, they were supposed to cut rates. They were supposed to come down 0.5%. So today they're at 6.26%. So they've gone from 6.11 to 6.26. Not a gigantic leap or change. And that's because hasn't been a whole heck of a lot of data until this week. There is labor data that's slowly coming out, and it's kind of been mixed so far. So it's at 6.26%. Now, the reason it did not go down 0.5% is because, and we talked about this a couple weeks ago, rates are already baked into long-term rates are already at the levels that they need to be for the federal funds to come down. And what I mean by that is the environment for traders and everybody on Wall Street. They look to see what they think the Federal Reserve is going to do, and they move accordingly. So they already anticipated rate cuts, especially after the most recent job numbers from the last couple of months that were so much lower than expectations. And so as a result, it was already built into the long-term rate, already had these Fed cut rates built into the long-term rate, the 30-year mortgage. So, and this is a good way of explaining it. So the federal funds rate was stuck at 5.5 since July of last year, all the way up until a couple weeks ago, towards the end of September. They were held steady at that threshold of 5.5%. So they didn't make a single solitary change since July of last year. Yet mortgage rates during that same time period vacillated all over the place. And like I said, that crystal ball represents where they think the Federal Reserve is going to be. When are they going to be more accommodating and bring rates back down rather than them being so restrictive like they have been for such a long period of time? So we had interest rates a year ago in October. By the time we got to the middle of October last year, just a year ago, we had interest rates that hit 8%. So that 6.26% suddenly looks way better than where we were just a year ago. And then 6 months ago, this was April, we were at 7.5%. We hit 7.5% 3 different times. So that was the height for 2024. And it came during the springtime, which really messed up the spring numbers. We really didn't get this slowdown, this anticipation of rate cuts until we got towards the summer, end of summer especially. Then we saw a pathway for rates to really come down. So it came a little bit late, and it's matching up with our fall market rather than with our spring or summer markets for housing. And you could see that since April of this year, interest rates have been slowly but surely making their way down. But they vacillate all over the place in anticipation of where things are going to go and all the different numbers that come out, economic numbers. The markets react to varying degrees. The biggest reaction comes from labor data. And we're actually recording this on October 3rd. October 4th is Friday, and that is a very, very, very important jobs day. Unemployment comes out and the number of jobs created comes out. And the expectations are for it to be right around 150. I mean, it's a little bit less, but right around there. So if we have jobs that come in way lower than that, all of a sudden you're going to get more people that flood the long-term stuff, and we'll see interest rates come down. That's what happens when there's some negativity where it shows some slowing in the economy. People like traders, investors like to diversify, and rather than look at stocks, they like to look at 10-year treasuries and mortgage-backed securities, which are interest rates. So right now we've been vacillating between that 6 to 6.25% right there. So it's knocking on the door of the fives. But then if we have a jobs report that comes out and it is higher than expectations, we can imagine interest rates can even go higher towards 6.5%. And that's just a bummer because sometimes that's the way the numbers and economics works. So we look at the overall trends, but you might get a data point that all of a sudden shows that things are a little bit better than what you had anticipated. So that trend is still intact, but that's one data point. You just need to see multiple data points of things changing in order for everybody to be on board with, you know what, the economy is definitely changing. So right now we're continuing to see a slowdown. We will see more tomorrow when the Friday jobs report comes out. Now, if you're wondering what's so important about interest rates, I'm going to show you, this is rates impact on affordability. And I'm here in Southern California, so we have reports that dot all over SoCal, the Bay Area, as well as Phoenix and Vegas, and we've also been tracking Sacramento. And haven't launched a report there yet, but you can see what happens with interest rates. If you're desiring a $5,000 per month monthly payment with 20% down, what happens, and I know that this is a lot for a lot of people, you can understand that if the desired monthly payment is less, you're still going to see the same type of a scenario where when interest rates drop, as a buyer, you're able to afford more home. And you can see last year at this time, $5,000 per month got you $851,000 of a home with 20% down. And back in April, we were at 7.5%. Now you're up to an about $94,000 home. And we got almost all the way down to 6%, and that is now a $1,042,000 home. Do you see the difference? Going from 851 to $1,042 is a gigantic swing, and that's just by interest rates coming down. Right now, we're playing around 6.25%, so we're about $1,015,000. But you can imagine that if we get underneath of 6, which is what a lot of people prognosticate is going to happen in interest rates next year, you could see what happens to how much home you can afford. A lot bigger of a lot larger of a home. And another thing to take a look at is just like, let's say you have a mortgage payment on $1 million home. You can do this with any mortgage amount, but $1 million home with 20% down is an $800,000 loan. And you're looking at back in April, a $5,594 payment for just principal and interest. Flash forward today, it's $4,926. That's an $8,000 savings per year compared to locking in an interest rate at 7.5% back in April. And we were knocking on the door of 6%. That's almost a $10,000 savings. So you understand, buying power increases exponentially as interest rates come down, and that is very, very important for buyers. And the lower they go, the more United States citizens can even afford a home. And that's the big thing, is everybody's talking about affordability, but there's definitely pathways for, if things slow down enough, for interest rates to get much, much lower, maybe into the mid fives. And then we have this ridiculous spread. I won't talk about that much, but I can tell you this much. When you look at the 10-year Treasury, the spread between where the 10-year Treasury is and interest rates is too high right now. It should come down, and it will, because the average spread between the 10-year Treasury going back to 1971 is 1.75. And if we get interest rates that come down to 5.5, and we just get that spread to come back down towards normal, we'll be under 5% for a mortgage rate. And you can imagine what that does to buying power and demand and everything else. Speaking of demand, that's what's happened. We've had these interest rates now for a little while at these lower levels, much lower than where they were during the spring and last year. And you can see in Southern California as a whole, demand actually went up 3%. And we've been tracking all of SoCal since 2012, and this was the largest increase for this time of the year. Not normal do we see an increase at the end of September. That's not normal. So it went up 3% during the 2-week period of time. Not normal at all. And I'm going to show you market by market. And you can see Los Angeles is up 3% for demand. Orange County went up 10% in demand in a 2-week period of time. Riverside up 2%. San Bernardino is one of those where it's kind of off on its own, and that's down 9%. And we keep snapping it. It's just slow to respond to these lower rates. It eventually will, but these lower rates are matching up with the slower part of the economy and not the economy, of the housing market. And as a result, they already have a lot of homes already built on the market so far this year. The demand that's going to come is most likely it will come, but it won't eat up enough inventory. So for the rest of the year, we're not going to see big changes in San Bernardino for demand. But these low interest rates, if they continue and they get even lower, it's going to match up with a very good winter and spring market of 2025. So you look at San Diego, it's up 7% demand. Bay Area is up 11%. Clark County is just flat, meaning that their demand didn't change from a couple weeks ago to now. Maricopa County up 4%, Sacramento up 2%. Overall, all the areas combined up 4%. So that is an increase when we normally almost never see an increase at the end of September. It's not ordinary. This is out of the ordinary. So as far as the inventory is concerned, it's a little late on the peak. Most peaks for markets happen between July and the end of August. Some of them, especially in the desert areas, are from about August to September. And then some actually don't even peak out until October, November, thinking that the snowbirds are going to buy their homes, when in reality, that does not match up with where demand peaks. Demands for all markets actually peak during the springtime, April and May. But the inventory is up 2% in the last couple of weeks. Should have already peaked, especially for Southern California and the Bay Area, but it has not peaked yet. And it's looking like a peak in many different markets. We're actually starting to see, because we're snapping numbers on a daily basis, and we're starting to see that it's coming down. So Los Angeles is up 1%. In a couple week period of time. Orange County was down 1%, which means that most likely we hit that peak in Orange County. Riverside up 5%, San Bernardino up 1%, San Diego's flat. I kind of looked at numbers today and it looks like it's slightly going down, which means we just hit a peak. Bay Area up 2%, Clark County up 4%, Maricopa up 5%. That's Phoenix area, Clark is Vegas, and then Sacramento's up 2%. All these areas combined up 2%. So we actually have demand going up faster than inventory at a faster pace. So as a result, we take our expected market time statistic. It's not days on market. It is a real statistic that gives us the speed. How many miles per hour are you going? The speed of the market. If you place your home on the market, when are you opening up escrow? That's what everybody should be concerned with. Buyers, sellers, everybody. Because there are different market speeds depending upon the market that you're a part of. And what we're seeing for the most part overall is when you have demand going up faster than you have supply going up, as a result, the market speeds up. Also not normal for this time of the year. Some markets exceptionally not normal. And in Southern California, it went down one day. It went from 95 to 94 days within the last day. In the last couple of weeks. So it's going the other direction, which, like I said, at this time of the year is not at all normal. And LA went from 100-day expected market time to 97. So it steps in the right direction, still very sluggish for Los Angeles County. And you're going to see a lot of home price index reports that show Los Angeles actually negative month to month. Orange County is lumped into Los Angeles. So it's LA, Orange County as a metro, which is strange because Ventura gets its own home price index. San Diego County, Riverside, San Bernardino, they get their own metros, but Orange County and LA are combined. So it makes it look like Orange County is also slowing down, which it's not. It's actually the fastest market out of all the markets that we're tracking right here. And you can see Orange County was at a 78-day expected market time, is now at a 71-day expected market time in a 2-week period of time. That is a real solid speed up in the velocity of the marketplace, and very, very noticeable. And then you have Riverside actually went from 100 to 103, and that's that. They placed more homes on the market because they think that all the snowbirds are going to come and purchase their stuff during the cooler months, and this is when people come on, which doesn't match up necessarily with demand. And you have San Bernardino went from 103 to 115. When you factor in how much demand went down in San Bernardino, it makes overall Southern California look like it didn't slow down that much. But if you take San Bernardino out of the equation, it really did slow down, and it shows in the data. San Diego went from 84-day expected market time to 79. The Bay Area went from 80 to 73. Clark County went from 97 to 100, slightly up higher because the inventory increased a little bit faster than demand. Phoenix, Maricopa, 95 to 96. Same scenario, just a few more homes came on the market than the percentage than demand. And Sacramento went from 82 to 82, so it's the same. Overall, all areas from 92 to 91. Not a big shift, but you can see it really depends upon the marketplace that you're in, and we're starting to see this shift in the marketplace anyways. And you could see it, and it will start to spread into other markets, especially down the road as the market evolves. Now, I want everybody to see this. This is from the MBA. This is the Purchase Application Index, and you could see on the right-hand side, that's where we are today. And you could see from about the 9th of August on, it really sped up from week to week. There was more and more people were actually looking to put in an application to purchase a home. So it actually spiked up to its highest level, most recent report going back to February of this year, when we had low rates to start off the year and everybody was gangbusters about, they thought that this was going to be a fantastic year. It ended up being really soft as the interest rates went up higher and higher, made their way all the way up 7.5%. But with interest rates playing between 6 and 6.25%, it is inviting a lot of people to come into the market, and that's why we're seeing as many people getting purchase applications. But like I said, these lower rates are actually matching up at a time of the year where it's typically slower when we get to the autumn. Number one market, spring. Number two, summer. Then you get down to autumn and winter and the holidays. So the biggest part of the marketplace is already in the rearview mirror. So you can imagine there aren't as many buyers in the marketplace, yet we see the purchase application index going up, which means it's inviting more demand. You can imagine if interest rates go even lower and we start off the new year, 2025, with lower rates, it's going to match up perfectly with the marketplace. And it will be off to the races, kind of like that spike you see in January. So, but these low interest rates have to remain with duration for them to continue to impact demand. Because as they come, slowly but surely, more and more buyers are invited, and you start to see demand increase, and they eat into the inventory, and inventory comes down. Kind of like what we're seeing in Orange County and San Diego, and a little bit in LA, and definitely in the Bay Area. We're seeing that we're reaching a peak. Even though more homes are coming on the market than last year, the inventory is starting to come down. And the reason that's happening is because there are more pending sales. There's more demand because interest rates have really cooperated with the fall market, not spring or summer, but the fall. So what's going to happen? If that happens, we're going to see this big rise in demand, and inventory levels after they peak, they continue to come down until we reach the lowest level by December 31st. And so we're going to get demand that really comes up, which is going to mean that as demand goes up and inventories come down, the market is going to get hotter. And as soon as we hit that new year, it's going to be off to the races in 2025. And that's kind of how it's lining up right now. But we're going to have to see what happens with all the data points going forward, because we have that big data point tomorrow being the jobs report that's coming out. So if you like what you've seen, please subscribe to our channel. You'll get more content just like this. We're all about setting expectations. I have people that don't necessarily agree with what we have to say because they want a certain narrative to take place. And we're not about that. We'll tell you when things are negative, or when things are going to crash, or when there's going to be a lot of foreclosures or things like that. But that's just not in the cards based upon everything and all the trends that we're seeing. So that's not where it's at. We're here about delivering the actual what's going on in the market with actual data, trend analysis, and from that, you can properly make expectations based upon what we are talking about. The most recent report that came out is called A Jump in Demand, which has come along. We released it for along the coast, LA, Orange County, and San Diego. And all the other markets will get it next week. Ventura got it as well this week. And then if you're not a subscriber, you should subscribe. And you should go to reportsandhousing.com and click on the subscribe button, and the coupon code is DEMAND for a free month. So please like this channel. If you like what you're seeing, subscribe to this channel so that you can continue to get these kind of updates. We really appreciate you tuning in. It's been fantastic. Hope you have a wonderful day. Remember, tomorrow, very, very important day. So go to CNBC or wherever you like to go to, your Wall Street Journal, online, or wherever you like to go to get all of your information so that you can see exactly what happened in the job market. This comes out from the Bureau of Labor and Statistics, and we'll be watching it closely like so many other economists. Thank you so much for tuning in to another Housing Debrief. Hope you have a fantastic finish to your week, and we will see